Okay, this is the weekly outlook for the 19th of October, 2025. Now we're going to begin with the Nasdaq on the weekly chart. And pretty much the only real thing that there is to look at here is this fair value gap. So when we traded down that day when Trump released those news tariffs about China, we traded right into this fair value gap and we closed at the consequent encroachment level. That's okay. That indicates support, and then we opened up the new week with a very large gap up. It trades up and up and up. The wick closes just underneath the consequent encroachment of that weekly premium wick, and we still close inside that premium wick. So there's a little bit of context there for what we potentially expect. We've traded down into a support level, and we've displaced higher. Okay, daily chart. This is where it's going to be a bit more important. I'm highlighting here a dealing range. Why is this the dealing range? Well, it's the first high, significant high, created after we take out buy side. So we take out buy side, here's the high that we leave, and we also take out sell side. A dealing range must take out buy side and sell side to be classed as a dealing range. Otherwise, you may just be looking at discount and premium levels, which is fine, but there will be some differences in behavior. So here in the daily chart, you can clearly see drops into that weekly fair value gap, takes out this external range low, actually has this order block as well. That leaves us with this dealing range, opens up here for the new week, and the next 4 days are pretty much at the consequent encroachment of that dealing range, or equilibrium rather. It wicks away, it wicks away, wicks away, wicks away, wicks away, wicks away. So there's 1, 2, 3, 4 outside days. 4 days of extreme volatility. Usually you'll get some kind of inside day if it's going to, close and open and close and open at a similar level. But we're actually in a weird scenario where we have these extended wicks, and we have previous day high gets taken, previous day low and high gets taken, previous day low gets taken, and the 14th of October's extreme wick low gets taken. So there's a lot of movement on this chart, and it also means that it's very hard to get a read on any good PD arrays here, except for that daily SIBI. So that means we'll be dropping into a lower time frame. Okay, here's a 4 hour, and we're looking at this in a little bit more detail now. There's a little more candlesticks and data to work with. So we have this new week opening gap. I'm going to come away from calling it the Trump's hole now, because I think that joke may have run dry. It trades below this low. This is the 14th of October's daily low. Trades below it, gives us a turtle soup. Friday we have a very large rejection in the direction of the buy side. We do have, now it's a lot easier to see, these relatively got highs up there at all-time highs, and that would be a strong draw from the looks of it. And any strong rally, if we're bullish, is good, and then any retracement on that rally should be a suspect rally, meaning we should look for potential longs there. It's a bit early to decide on our bias yet, but it looks like we have strength here. We'll obviously need to go down into lower time frames, but from the 4 hour, and I'm saying this stuff because it's giving you context in how you should be treating these time frames. From the 4 hour, we have, a lot of displacement higher, so that would be likely followed by displacement higher. You'd expect. We'll talk about that more on the lower time frames. Here you can see it wicks down into the consequent encroachment of this daily premium wick, and then it rebounces and trades higher. This is taught in ICT's 2025, I don't remember the exact date, but the first video he made in the later part of the 2025 mentorship, trading all-time highs, this is taught in that video. So if you want to go back to that video, you'll see this methodology used there. Here we have this bounce price range, we have this SIBI. These are very big and not very accurate PD arrays. They are accurate in the sense that they're drawn out correctly, but they're not giving us a lot. So rather than using these, I'm going to take these off, and we're going to go down to a lower time frame, and we're going to get more information from those, because this isn't really giving us anything that we can read effectively. It's just a large gap. You don't really want a huge gap. You want something a bit more concrete, a bit more obviously reliable, and something this far into the premium of this impulse price swing, it's just kind of hard to say if it's going to react with support or if it's going to give us resistance. Apologies, I went to the wrong slide. We're on actual trading view now. So this is the hourly chart. Here's a consolidation from the 8th of October to the 10th of October. We really don't leave this range by a lot. It's just high put in and a high put in. So we have relatively equal highs up here. That's important because it means that we could potentially trade into that level. This could act as a draw. And it's also the high of our dealing range. Now you'll notice these quadrant levels. This blue line is the lower quadrant. The red line is the consequent encroachment, equilibrium. We say equilibrium with dealing ranges. And this blue line is the upper quadrant. And again, we don't use these for tick-to-tick perfect precision, but we use them as general areas of where's price trading, and it helps build up the idea of narrative. So it's trading and it works away from the lower quadrant. Okay, that's strength. It does trade higher all the way into the upper quadrant, rejects the upper quadrant, trades into consequent encroachment, trades lower into the lower quadrant, takes out that low, displaces away from this, uses the daily premium wick consequent encroachment level that we mentioned earlier, and this fair value gap's upper quadrant, and it leaves this nice V shape, and it trades away and keeps trading higher. So I'm going to clean this up a little bit by taking off that daily wicks premium consequent encroachment. You'll just have to remember that level was there. So if I zoom in a little bit more here, we have this long-term low. Why is it a long-term low? Well, it's between two intermediate-term lows. Yeah. Intermediate-term low, intermediate-term low. What I really want you to focus on here is the way it moves. So it didn't just take out this low and this low. What did it do after that? It traded down below it, thin, nice and thin, with inefficient price delivery, and then it sweeps this low just about, and then it gives us another thin run up. So we have these overlapping inefficiencies. This is a volume bounce, so you can use this as a bounce price range. And it doesn't trade back into its bounce price range. It uses the fair value gap's upper quadrant level and that daily wicks, the daily premium wicks consequent encroachment level. And it pretty much just respects this, trades away, has a weird, outlandish wick by trading up, down, but this is the 10 o'clock hour. Things like this can sometimes happen. Opens up down here, trades back lower into this upper quadrant, and then it's traded back higher, and it's kept going. So this is the beginning of this price run. There's a lot of strength. It trades down and then it trades up with a lot of strength. It really powers through. It leaves the bounce price range there. It gives a really nice upper quadrant delivery of this fair value gap. This is all the stuff that you want to see for bullish price delivery. Now I'm a little bit not impressed with how wicky this was. I would have wanted this to be a little bit more straight shot up without these constant weird wicks. But it's okay. It doesn't mean that we're going to completely be bearish now. It just means that if we're going to be bullish, we might have a little bit of a deeper retracement or some lethargicness on Monday before going into Tuesday, Wednesday, Thursday, and Friday, and potentially drawing into this high. So I want to see us trade towards this high. Potentially even get all-time highs this week. The only thing that would hinder that is the fact that we had a very wicky move up, whereas the reversal was real strong. There was a lot of strength here. And it even left this bounce price range. It left most of that fair value gap. This is real nice. But then the way it is working up here, it's a little bit less ideal. And we'll have to see how Monday opens. And we'll also just have to see how Monday goes before really picking a weekly bias. The thing with Monday is if it's not consolidation day, it can become really obvious after the London session's done where it wants to go because it's engineered those Asia highs or lows and the London highs or lows. So it's hard to say right now, but then on Monday I'll be like, with a lot more conviction, I can say this would happen or this would happen. But from a Sunday before market open perspective, I would expect this week to draw towards this high. There's not really a whole lot that can stop that, in my opinion, except for the fact that we had really a little bit less than ideal delivery to the upside. I would want buy side delivery that's a lot cleaner. This is still okay. Again, it doesn't mean that we're going to be bearish. I'm still bullish, but instead of just having a straight shot up, it might, be a weird Monday, stick around for a while, and let the dollar get going and then trades higher. That's always possible.